Welcome to DF Markets Candlestick Reading. Candlestick reading is one of the core constituents of technical analysis. The reason for this is the usefulness of candles in understanding the movement of price. The shape and size of the candles reveals important information about how price has moved and can be used to anticipate how price will move in the future. There are four main price points to consider with candles: the open, the high, the low and the close. If price moved higher over the session, the candle is green, and if price moved lower over the session, the candle is red. The shaded area is called the body and a tail at either side of the wick. When it comes to understanding what different shapes and sizes of candles are telling us about price, there are a few key candlestick patterns to focus on. Pin bars. Pin bars represent an acute shift in market sentiment. A bearish pin bar shows that buyers were in control, initially driving price up before sellers stepped in strongly and drove price down to reverse gains. This candle signals that a price is likely to continue moving lower. Bearish pin bars are best found at resistance levels or during a correction to a bearish trend. Bullish pin bars show that sellers were in control initially and drove price down before buyers stepped in and drove price up strongly higher to reverse the losses. The long tail and a small body is a telltale sign that the market is vulnerable to a larger reversal. Bullish pin bars are best found at support levels or during a correction to a bullish trend. Harami candles or inside bars. Inside candles are a pattern identified by a larger mother candle followed by a smaller baby candle, which forms totally inside the range of the first candle. Inside candles represent a loss of momentum and a change in sentiment in the market and can be a strong sign that the market is about to reverse when they occur at supports or resistance levels. Alternatively, inside bars which form during trends represent a pause and a contraction in momentum and can be a great signal that the trend is set to resume again. Engulfing candles or outside bars. Engulfing candles are the opposite to inside candles and are identified by the presence of a small initial candle followed by a candle which is greater than the range of the prior candle. These candles represent a strong shift in market sentiment and can be a powerful indication of a forthcoming reversal where they occur at support or resistance levels. Dojis. Doji candles are identified by their tails either side of a thin neutral body, which make them look like a cross. Doji candles can take a slightly different shape and size, but essentially wherever you see a candle with a very thin body and tails either side, this represents strong indecision in the market and the potential for a reversal. Bearish dojis form at the top of a bullish move and bullish dojis form at the bottom of a bearish move. A great way to use the doji candle is to use them in conjunction with an indicator that shows divergence. For example, if the RSI indicator is showing bearish divergence and a doji forms, this can be a great signal that the market is likely to reverse.